Good. So today we look at the revaluation model. The revaluation model. Good. The revaluation model. But before that, we said that the subsequent model or the subsequent measurement, subsequently, subsequent measurement. Here we are saying that subsequently, the entity should measure the PP between these two models. So select one. First, cost model. Second, revaluation model. Revaluation model. Good. So these are the two options or models available for an entity in the subsequent measurement. In fact, all of them are looking for one item. All of them. So all of them are looking for the value to be placed on the PP. And that value, we call it what? The current amount. Current what? Amount. So all of them, they are giving us how we can obtain the current amount of an asset. So how to obtain the current amount of what? Of PP. So PP is good. So that is it. Good. So how to obtain the current amount of PP. We look at the cost model. So today we are going to look at the revaluation model. Good. So that is it. So basically, that is the game. All of them, they are looking for the current amount to be placed on the PP. So cost model will say that bring the cost of the asset less accumulated depreciation and any accumulated or impairment loss. So this one will tell you that okay, if you want to determine the current amount of the asset, relax. Bring the cost of the asset less any accumulated depreciation, any accumulated impairment loss. That is the cost model. And we look at it, we have looked at it last session. And today we are looking at the revaluation model. Now let me single the revaluation model out and then let's look for, let's consider what it talks about. The revaluation model. Revaluation model. Now, the revaluation model states that if you want to determine the current amount, relax, cool down, bring two items. If you want to get the revalue, the current amount, so here is the current amount of an asset is equal to, so relax, bring the revalued amount, in which we also call it fair value, which we also call fair value. Sorry, fair value. So fair value. The revalued amount is also called fair value, less any subsequent accumulated depreciation. So here will be less subsequent. The word is subsequent accumulated depreciation. Again, less subsequent accumulated impairment loss. So that is the game. So all of them, they are looking for one item, which is what? Carrying amount. But what's the difference between the revaluation model and the cost model? This is the difference. Under the cost model, so current amount is equal to, over here we say cost of the asset less what? Just accumulated depreciation, no subsequent. Less what? Accumulated impairment loss. So have you seen the difference? So have you seen the difference? Now the difference is a bit clear. All of them start with carrying amount. Just that here said fair value. And this one is what? Cost. Accumulated depreciation and subsequent. I'll explain why I use the word subsequent. Basically, that is the aim. So, in fact, the cost model, if you look at it, so here, you're not going to look at the cost model. Already look at the cost model. So, now let's go straight. Revalued amount is the fair value. The revalued amount of the assets is the fair value or the market value or the current value of the asset. And if you look at the definition of revaluation at the initial stage of these standards, the terms that we defined. So basically, that's now the subsequent accumulated depreciation. Here, after valuation, the asset details vanish from the book. The left it was just the fair value. So any depreciation must be the one that's yet to be charged off after the valuation. Good. So that's why we use the word subsequent accumulated depreciation. Good. For instance, we bought assets January 2010 at a cost of 50 Ghana cedis. Then December 2010, the same December 2010, with the same as January 2011. Good. So you did a valuation and you had 60 studies. So 2011 December, what happened? 2011 December and 2012 December, what happened there? So it means that when you did a valuation here, this is where we did a valuation. So the current amount of the asset will be the fair value less the subsequent accumulated depreciation. It must be the depreciation after the valuation. So depreciation after the valuation. So that's why we use the word subsequent, because any depreciation charge before the revaluation must be cancelled. Any depreciation charge before the revaluation must be cancelled. So from here coming, any depreciation charge before the valuation will be what? Cancelled. So the only depreciation that's left out to deduct is what? The one that's after the valuation. So from here going, so that is the subsequent accumulated depreciation. Good. We look at some few rules. It said that there are three rules if you adopt the revaluation model, or three conditions need to be satisfied. Condition number one, the evaluation must be performed by a qualified independent valuer. Qualified independent valuer. And here we stated that the accountant cannot do that. Accountant is not quantity surveyor. Accountant cannot determine the value of a building nor vehicle. Accountant is not an engineer. So you have to employ the service of what? A qualified professional valuer to perform the valuation. But even when the external auditors come around, they have to even assess the qualification or the level of the quality work performed by the valuer. So that is it. Two, we also said that the evaluation must perform what? Periodically. Good. And then the third one, we said evaluation must be done on a class by class asset. So if a particular asset is being revalued, the entire class must be what? Must be revalued. So that is the three conditions. Good. Now we look at the revaluation differences. We said that anytime you perform revaluation, two things will happen. Either you're going to gain or going to lose some of the asset value. So we look at the calculation of the revaluation gain or loss. And we said that if you want to calculate the revaluation gain or loss, just relax. Two items. The fair value. Bring the fair value or the revalued amount. The revalued amount so much less the carrying amount. Less what? The carrying amount. So this will give us, if it's a positive figure, it's a gain. If it's negative, means that the revaluation loss. Good. So that is the formula for determining the revaluation gain or loss. So that is it. Good. So this will be revaluation gain or loss. How do you treat revaluation gain? How do you treat revaluation loss? We said that gains must be reported in where? OCI with exception. So today let's look at some few illustration. Okay. But last week we ended at good. We ended at the calculation of the revaluation gain. That's where we ended. So from our last illustration, we ended at calculation of the excess depreciation plus the calculation of the revaluation gain or loss. Good. So today we are going to look at the treatment of the revaluation gain. That's where we are going to continue from. So how do you treat the revaluation gain or loss? Now we know how to calculate it. We're using the APUSCA example. Last week, the example that we used as the APUSCA. Good. So how do you treat the revaluation gain or loss or the revaluation differences? And how do you treat any asset depreciation that may arise? Good. So that's the next topic. Now let's look at that one. So first, let's pick the revaluation gain first. Accounting treatment of revaluation gain. Accounting treatment of revaluation gain. Accounting treatment of revaluation gain. So first, two treatments. First, add the gain to the carrying amount of the asset. Where carrying amount of the assets. Add the gain to the carrying amount of the assets. Add again to the carrying amount of the asset. Add again to the carrying amount of the asset. Then the second treatment is A and B, the general one and then the exception. So first, add the gain to what? Add to the OCI, which is same as revaluation surplus or reserve. Revaluation surplus account. Revaluation surplus is also called capital surplus. So capital surplus. Good. So any of these two, that is it. So let's recall last week's example. So the last example, we had revalued amount was, if I do remember, the revalued amount was 60, and then the current amount was 40. So there was a revaluation gain of what? 20. How do you treat the revaluation gain of this 20? So we are saying that relax. Add this 20 back to the current amount. If you do that, it will return you back to the revalued amount. So we say that right after valuation, the asset value will be what? Will be stated at the fair value. So the asset value will be stated at the fair value. That's the first treatment. So therefore, the financial statement, the asset value now becomes what? Current amount of 40 plus revaluation gain of 20, making what? 60. We've not done anything. This 60 is the same as the fair value. Good. Second treatment, go to the OCI. You know, in the profit or loss statement, beneath it, we have what we call the other comprehensive income. The other comprehensive income, when you go there, you got OCI here, and you write revaluation gain of what? 20,000. You are done. So these are the two treatments. After adding to the current amount of the asset or the cost of the assets, you add it to the revaluation gain, and then you are done. So that is the two treatments. Now this is the debit and this is the credit. The first one is the debit entry, and this is the credit entry. Good. Now we are done with the general rule. Let's go to the exception, especially the second section. There's an exception to it. So add it to the OCI. That's A. B. Except where there was what? Previous loss. 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 Except where there's previous loss. Good. So we'll look at it, and please, the exceptions. Kindly master the exceptions very well for us, because that's the examiner's stronghold. Student weak point. Good. So except where there was what? Except where there is previous. Previous what? Revaluation loss or impairment loss. Where does previous loss? Good. So here we are. This is what we are talking about. If there was a previous loss, you cannot record all the revaluation gain in the OCI. That is the bottom line. If there was a previous loss, you cannot record all the gain in the OCI. Then what do you do? Until the loss is cleared, no figure enter the OCI. I repeat, until the loss is cleared, no figure should be reported in what? The OCI. Now let's back with the illustration. especially the exception or the exception to the general rule. Good. And please, the exception applies to only the second, the credit aspects. It does not apply to the asset section. So the exception applies or holds only when you are recording the credit aspect, the gain at the comprehensive income. Good. So that is it. So let's take notes that the exception does not affect the assets. So if there's a gain, straightforward, asset, increase it, you are done. But when you come to the OCI, then ask yourself, do we have a loss coming from the same assets as a result of probably previous revaluation loss or even impairment loss? Every loss is loss. These losses are two. Impairment loss and revaluation loss, they are the same. Treatment of them are the same. So impairment loss and revaluation loss. Now, in November 2017, the examiner did that. They used impairment loss and revaluation gain. So they were testing the students how to account for the exception. Then you are done. So now let's use this illustration. So can I take the screen off? The board. Good. So thank you. So let's see how the entries will be. So I'll go through some few of them, and as usual, if I do one, you do one. Then like that. This is the question solving stage. Good. So almighty example, the cost of the assets was 100,000 Apusika Limited. And then the number of years, they bought it first January 2010. It will be 10 years. And then second, they said that on 31st December 2015, the asset was fair value, which was 60,000 cedis. So great. So this was the question. In fact, you are going to update this question. It's going to be a very champion question. Good. You've been updating it from time to time to get what we need. Now let's see. We calculated the current amount and we had what? 40,000. And we performed the revaluation gain or loss. So we started revaluation gain or loss. We said that the revalued amount was given to us to be what? 60,000. And then the current amount, the accumulated depreciation is for 6 years. From 1st January 2010 up to 31st December 2015 is 6 years. So therefore, the current amount is 40,000. But you can also use the shortcut. How many years remain? 11, 4. It means that the current amount is nothing by 4 out of 10 times the overall amount 100. It will give us 40,000. We took the current amount off, then we had what? Revaluation gain of what? 20,000. Now this 20,000 was the accounting treatment. If there's no previous loss, no exception, then the treatment will be a bit straightforward. Just go like this. What will happen? First, you go to your P&L. What will happen in the P&L? You said that OCI, we record it in OCI as what? Revaluation gain. Revaluation gain of 20,000 here. And we said that the gain must be added to the carrying amount of the asset. So therefore, in a financial position, what do I do? I'll name the asset. Let us know it's plants. So plants. I'll open a bracket nicely. The carrying amount is 40,000. There's a gain of what? 20,000. So when I add, I'll get 60,000. So this is the treatment. This is the general treatment of revaluation gain, where there's no previous losses, where there's no issues. Now let's bring the issue in. Have you seen? We have solved it where there's no issue, and we are going to solve it where what? There are issues. So this is the main treatment. First, you calculate your revaluation gain or loss. Second, you do the treatment, you are done. Now, in events, we are starting the issues here. In events where there's what previous loss as a result of previous valuations or impairment loss incurred previously on the same asset. Now let's assume that in a question there was a previous revaluation loss, so previous revaluation loss of 5,000 Ghana cedis. Previous revaluation loss coming from the same asset. It must be from the same asset. It's 5,000 Ghana cedis. So we have updated the question. Please do well to update your question too. I've added one part to it. So kindly update your question. Previous revaluation loss incurred from this asset is 5,000 cedis. Yeah, the examiner can use dates. They can tell you that even though we did the valuation on 31st December 2015, you can tell that okay, previous valuations on this asset, the loss is 5,000. Good. Good. So that is it. Now we are saying that when there was revaluation, first bring your revalued amount, get a carrying amount, take it off, you get a revaluation gain or loss. If it is a gain, relax. Add it to the carrying amount of the asset. It will return you back to what? The fair value. Don't get worried. Means that you are correct. Then the same gain, send it to OCI. That's a general view. Go. This treatment, especially the OCI section, there's one exception to that. And that's what we are going to look at it now. The exception to the general rule. Here, there's a previous loss. Here, we are saying that until this loss is cleared, no figure enter the OCI. I repeat, until what? The loss of 5,000 is cleared, no figure should enter in. And then the question is, when they incur the loss, where have they recorded it? Good. Okay. Let me strongly write before. You write AGA, but about what to do now? Comprehensive income. Comprehensive income. No shortcut in exams. So that's the OCI, other comprehensive income. So that is it. Now, where there's previous loss, you have to make some few amendments or few changes. And then you are fine. So where the previous loss, what do we do? So first, the asset section will not change, will not be affected. No. The exception does not affect assets. It only affects what? the OCI section. So let's see how the OCI will do. Now the question is this: this loss of 5,000, where all loss enter the P&L, loss it will be part of the all loss will be part of what? Part of the operating expenses. So to be added to the operating expenses. So it means that that loss is sitting in the P&L. Let's go there and invest it. Now we are saying that this is the treatment of revaluation gain, but sometimes there will be exceptions. Where there's a previous loss, here we are not treating revaluation loss, no. So after here, we go and pick revaluation loss to and treat it. But all of them have exceptions, especially revaluation gain. Good. Now let's see. As soon as the same asset previously did evaluation had a loss, they've recorded it already. We are not going to record the loss at first. No, they've done the recording. So they will inform you that okay, this asset gave us a loss some time ago when we performed the evaluation. So we are not going to record this loss of 5,000. No, they've recorded already. It's in the book. Just that we have to reverse it because one asset last week it gave you a loss of 5,000. Today it's giving you a gain of what? 15,000. So you tell yourself that you've made a gain of 15,000. No, you can't tell yourself that. So what do? That means your gain is 10,000. That's all what I'm talking about. Your gain is 10,000. It's not 15. But the same asset give you a loss some time ago. So don't forget. Yes. So that is it. So let's see how it will appear. Wherever this loss is, a portion of this 15,000 must be what? Released to wherever that loss is. Whoever that loss is. Good. Great. So the question is, this 5,000 is sitting in a P&L within the operating expenses. So we have to go there and reverse it. So now let's go. You know, there's a difference between other comprehensive income and P&L. This is an adjustment to the P&L. The latter part of the profit and loss is the other comprehensive income. So you go to the other here. Next, what we do in this, in a P&L, we record revaluation gain of what? 5,000 bracket reversing the loss. Reversing the loss. So 5,000 must be released. So I've released what? 5,000 to the profit and loss to release. Then second, I'll go to OCI. If there's any balance, I record it in the OCI. So it means that in the OCI, I'll record what? Revaluation gain of what? How much did I record? Good. So now what will be the value? Any idea from me? Good. So therefore, left a gain of what? 10,000. But this one is not 10,000. Here must be 20,000. Here will be 15,000. Agree. So left with a gain of 15,000. Because the total gain is what? Yes. But the total gain is 20,000. We have 20,000, but because the previous loss of 5,000, that loss is sitting where? P&L. The portion must be released. This is credit. This one too is credit. All of them is credit, credit. Good. And this is the debit. 20,000 debit. Then to balance nicely for you. Good. Now let me do small alteration. Then you try. What if the loss over here Let's do the rotation. What if the loss over here happened to be 22,000? Wow. The loss was 22,000. How would the arrangement be? Previous loss 23,000. Good. Any idea? Trial. The loss happened to be 22,000. What do you do? If the loss happened to be 22,000, it means that the gain that we have 22 is not enough to even clear all. So nothing will go to the OCI. So entire gain will be what? Used to set off some part of the loss. So the entire gain of 20. So in that case, the P&L, I record the 20. Oh, again, must be released to go and then cancel what? The entire loss. So all the 20 must be released to the P&L to offset. And then the revaluation gain will be what? Is zero because nothing left. They still even have a loss of 2,000. The next time when they do the valuation, there's a gain, they will set off that one too. And then until that 2,000 cleared, no figure should enter the OCI. That is the treatment. And I can assure you that your examiner is going to move you between this. Yes, they will move you. Financial reporting, preparation of financial statements, and then the standards on its own. They'll move you through. Yes. So if you can get it from me, we fine. So I'm done with the revaluation gain. What if here the loss happened to be 20,000? What happened? The loss is 20,000. Okay, I like that. So why will we record the difference of 2,000? Good. Why will we record the difference of 2,000 when it happened to be 22,000? If the loss happened to be 22,000, it means that the loss of 22,000, we've cleared 20,000. Then the 2,000 must be carried forward to the next period. So the 2,000 will be the revaluation, it will be among the revaluation surplus. Because the open balance of the revaluation surplus, 10,000 that they have only one asset is 22,000. It's 22,000. They have only one asset, it's 22,000. Yes, good. So to be carried forward. But just that that's 2,000. We are not going to show the entry. They've already recorded in the P&L, and that loss is sitting in the books. Sometimes the loss to be in the P&L, so it's in the retained earnings. Good. So we have reduced the loss by what? By 20. So that be 2,000, and then basically that is it. So in short, we will perform this entry and then we are done because the loss has already been recorded in the P&L. So that is it. So the 2,000 will be sitting in the P&L and it's in the retained earnings. So it will set off. Good. And the 2,000 will still be in in the books. Because this one is a balance. The revaluation loss that they give us, it's a balance. So the 2,000 will still be in there. Then we are done. Great. Now let's move on to the revaluation loss. What's the treatment? All what we've done, the reverse is the same for what? Revaluation. The reverse is true for revaluation loss. But let's look at it. Let's look at the revaluation loss. Again. Great. Revaluation loss. Accounting treatment of revaluation loss. But before that, if you do have any question, kindly let me know. about the treatment of the revaluation gain, especially the exception to the general rule, how we treated the exception, and then you'll be fine. Don't worry, I'll give one right now for you to do right after the revaluation loss. Good. Great. Now let's look at the revaluation loss. Accounting treatment of revaluation loss. Then we are done. We are what? Done. We will still be updating our existing question. So all what you've done under the revaluation gain session is valid. The reverse is valid. Good. Now with the revaluation loss, in fact, the loss must be recorded in the profit or loss as expense, and it must be subtracted from where? From the asset value. From the asset value. Good. Okay, good. There's a question here. How will the previous loss of 22,000 be recorded in the financial position? Good. In the financial position. Now, in the financial position, it will be among the it will be among the changes in equity. It will be among the changes in equity. Good. So all what you have to do is reverse a portion of it. So it will be in the retained earnings. So all what you have to do is we have to reverse that portion in a P&L. It will clear off because that 22,000 loss, they've already recorded it in a P&L. Last year's P&L. Let's assume that they had it just last year. So in last year, they have subtracted 22,000 from their profits. But today we had a gain. So we said, okay, a gain of 20. So we went to the profit and loss and top it up by what? By 20. So it means that, but this 22,000, we shouldn't forget that this 22,000 is not for this year. So it will not be in this year's financial statement. It will not be this year's financial statement. Good. So that is it. So it will be, this is the previous year. We show 22,000 as loss. This year we had a gain, so we've reversed 20,000. The remaining 2,000 will sit in the changes in equity. It will be in the changes in equity. That is the retained earnings. It's in the retained earnings. So next time when we had any gain again, what do? We offset the remaining 2,000. So the 2,000 will not appear. We're not going to record the 2,000 anywhere. The 2,000 will not be recorded anywhere. It will still be in the books. All what you have to do is you reversing the 20,000 from the P&L. We are done. That is it. That's what we are interested in. Most often, most often the loss will not be more than the gain. The loss will not be more. So to be around 15,000, but if it's more, this is how you have to treat it. Good. Now let's quickly look at the revaluation loss. So that I'll give you, or we look at some few trials. But this section are a bit important. Good. Now let's see. Revaluation loss. Revaluation loss. Revaluation loss. Revaluation loss. Now the treatment 2, 1, and then 2, 2A and 2B. As usual, there must be exception. So obviously the treatment 3. So first, 1, 2A and 2B. B is the exception. First, loss. Subtract it from where? The carrying amount of the asset. So subtract from carrying amount of the asset. Subtract from the carrying amount of the asset. Subtract from the carrying amount of the assets. Good. Subtract from the carrying amount of the assets. So that's the then 2A. Subtract from the carrying amount of the asset. 2A. That's the add to the operating expenses in a P&L. Add to the operating expenses in a P&L. Add to where? The operating expenses in the P&L. That means it must be expense. All the revaluation loss must be expense. And here too, there's what? Exception. Except for where there's what? Can tell us previous what? Previous gain. I like that. So that is it. So where there's previous gain to you cannot recall. Oh, so except where there's previous gain. So except where there's what? Previous gain. Good. That is it. So here too, let's back it with what? Illustration. We'll go through plenty of them and then you'll be fine. Good. Now let's see. Let's come and then revise our question. Let's assume that this question, the revaluation value or the revalued amount happen to be 35,000. The revalued amount is 35,000. So that's what I've updated in the question. So I've updated all the other items remain constant. I've updated the fair value. So I assume that the fair value is 35,000. How would that one be? Good. Now let's quickly go to, so you are looking. So first, the revalued amount will change to what? 35,000. Carrying amount is still the same. No change anything about the carrying amount. So therefore, the carrying amount is 40,000. So therefore, there's revaluation loss of what? 5,000. There's revaluation loss of 5,000. There's revaluation loss of 5,000. How do you treat this 5,000? So that's what we are going to look out for. And then from there, we look at the exception. Then we are done with the revaluation. Good. Now let's see. So let me dust the board and then let's see the relevant extracts that we have to prepare. So first, what goes to the P&L? Our P&L will look like this. So we'll tell the examiner that revaluation loss into bracket to be the operating expenses, and the amount is the loss is 5,000. And we said that in a financial position or extract, that's the PPE schedule. You take the loss from the carrying amount of the asset. So therefore, the name of the asset is plant. Open my bracket. The carrying amount is 40,000 less 5,000 to give me what 35,000. This confirms that anytime there's revaluation, the asset value becomes what the fair value right after the valuation. Good. And that is it. Okay. So what do you do again? Yes, with this we are done. Now let's do the exception. Now let's assume that this asset they did the revaluation last year, just last year, and then they had again or previously they did the valuation, they had a revalued or revaluation gain of what? Revaluation gain of mm, revaluation gain of, let's assume 3,000. They had previous valuation gain of 3,000, so I've amended it. Good. How would that one be? Here the asset section two is the same. And here, until the gain is cleared from the OCI. Where have they recorded this revaluation gain? They've recorded it where? OCI. That's when they had the gain, not this year. So they had this gain previously. So that year that they had this gain of 3,000, they recorded it in where? OCI or the revaluation surplus account. Good. So that means wherever this gain of 3,000 is, let's release a mantle of what? Of a revaluation gain to go and offset it. So wherever that gain is, a portion must be released. So this gain is in OCI. So you go to OCI. You go to OCI here. You open bracket nicely. Tell the examiner that revaluation gain. But once it's a loss, it must be in brackets. So first, the revaluation, here the loss. So we say revaluation loss. Then we are releasing what 3,000 go and offset it. So 3,000. You put it in brackets. That means here we cannot record the entire 5,000. Left with what? 2,000. Agreed. So only 2,000 be recorded in where? In the profit and loss as the revaluation loss. Why? Because out of the 5,000, a portion has been released to the OCI. So it means that the revaluation surplus balance will be what? The revaluation surplus balance that will be carried forward in the financial position under the equity section. Under the equity section, the opening balance was what? 5,000 negative. It was 3,000 gain. 3,000 gain. Then we release what? A 3,000 loss to it. So therefore the balance is zero, nil. That is it. If I achieve our aim. Good. So that is it. Now if you do have any question, can you let me know before I do the last massage? The last massage. Okay, now let's start the whole game again. Let's start. Let's start. You did valuation and you had a loss of 5,000. In fact, I have to put in bracket too. This one is a loss of valuation loss of 5,000. And now this loss, if there's no previous gain, the entire loss must be in the P&L as expense. But here there's previous gain of 3,000. What do you do? Wherever that gain is, a portion of this loss must be sent there to go and cancel that gain. This gain, when they had it, they recorded in where? OCI or the revaluation surplus account because all gains go to OCI. So create a section of the P&L OCI, call it OCI, and then let 3,000 of this loss go there to use to cancel this. Direct revaluation loss of what? 3,000. So I'll come here and record 3,000 in brackets. Have it there. Good. What was the total loss? 5,000. If I've sent 3,000 to cancel this loss, to cancel this gain, how much left? Good. And that 2,000 went to the P&L. So I'll go here and write revaluation. This section and this section are different. So if you record it here, it's wrong. It must be on top of the OCI. Good. So revaluation loss, the difference of 2,000. How do you get the 2,000? Bracket 5,000 less 3,000. Then you are done. So basically, that is a treatment. Now, you are trying this. What if the revaluation gain happens to be 5,500? You are trying it. If I do one, you do one. If the revaluation gain happens to be 5,500, what's the treatment? Good. What will be the treatment if the valuation is 5,000? Good. So try that one for me, and then what if the valuation gain happen to be 5,500? Then you try that one for me. The valuation happen to be 5,500. Gain. The gain happen to be 5,500. Still, our loss is 5,000. How would the should be? Great. Now let's look at this. So it means that first, a portion of the gain must be released to the wherever the OCI is to offset what the gain. But here come this gain is more than the loss. So what do? You can only cancel up to the tune of what the loss. So therefore, wherever that gain is, and that gain will be where? Will be in the OCI. So go to OCI and record 5,000 there. So I'll go there and record 5,000. And nothing enters the P&L because all the loss has been what? Exhausted. So the P&L, nothing enters there. I'm done. That's the treatment, and that's the credit section. It ends there. If you are looking for the revaluation, the remaining balance of 500, the remaining balance will go to the financial position. We record what we call revaluation gain of what? Of 500. How do you get the 500? Because the opening balance of the revaluation surplus account is 5,500. And with less a loss of 5,000 from it. So therefore, left with what? Left with the 500. So this will be the treatment. The 500 will go to the revaluation gain or revaluation surplus account. Let's make it revaluation surplus. Revaluation surplus account in the financial position. Good. So that is the treatment. Great. That is the treatment. So now we are at the question solving stage, right? Good. If I do one, you do one. One to one mapping, then we are done. So let's try this illustration. Then we'll go through some of the past questions to look at some few issues there. Please, November 2017, May 2018, and November 2018, these three sittings, there was a question on that. Try as much as possible to do two of them. 2017, May 2018, and November 2018. These three sittings, there was question that they were moving them from the the exception. So take note. So example 5. Let's try example 5. Sorry, illustration 5. Illustration 5. Illustration 5. Great. Let's just try. Now let's look at it. It says ABC Limited has an item of land carried in its books at 13,000. Good. ABC Limited has an item of land carried in its books at 13,000. Carried in its books at what? 13. So that 13 is what? The carrying amount. 13. Now let me make this statement. We don't depreciate land, the freehold land. So land should not suffer for depreciation. I think when you are solving questions to come in it, some of the questions they are in it. There are two types of land: freehold land and then the leasehold land. Instead, we depreciate leasehold land, but we don't depreciate freehold land. So let's take it. 2 years ago, a slump in land values led the company reduce the carrying value from where? 15,000. Okay, so that means there was a previous what? Loss of previous loss of 2,000. Great. So there was a previous loss of 2,000. So it means that previously the value of the asset was 15,000. So let's go to the board. It suggests that the value of the assets it means that the value of the assets previously was 15,000. That's the land. So the land previously had a value of what? 5,000. The land previously had a value of 5,000. The land had a value of, sorry, it's worth 15. I'll apply your breakup. Good. Now the land value previously, let's say last year, it's the last 2 years, so last 2 years, 15,000. Currently, the current value is what? 13,000, right? So that means previously in the books they had what? A loss, right? So there's a revaluation loss of what? 2,000. Good. So that's what they are telling us. Now let's continue the game. If you can analyze it like this for us, that's all. And this was an expense in the income statement because revaluation loss must be what? Expense. So this 2,000 was what? Expense in the P&L. Good. There has been surge in the land prices in the current year. However, the land is now well toward 20,000. So the value of the land now is 20. So today, the value is what? 20. So the current value. So here the revalued amount. Let's calculate the revaluation gain or loss. So to calculate the revaluation gain or loss, we said that revalued amount. So the value today is what? 20,000. The value previously, so the carrying amount is what? Carrying amount is 13,000. So in short, there was what? A revaluation gain of what? 7,000. Meanwhile, this 7,000, previously they did the valuation and they had what? A loss of 2,000. So therefore, how do you treat it? We said that anytime there's revaluation gain, first, you add it to the asset carrying amount. Second, the gain must be recorded in the OCI except for where there's what? Previous loss. And here too, there's a previous loss. So what we have to do is first, you have to go to the P&L and reverse this 2,000 from there. Good. So that's what we do first. So first, in the profit and loss account, this 2,000 will be there, and they told that they've expensed it. So I'll go there and record revaluation gain of what? 2,000. So therefore, this credit. Then I'll go to OCI and now record the remaining balance. Revaluation gain of what? Gain of 5,000. Good. Also credit. Then finally, I'll go to the financial position and tell the examiner that in the financial position, I'll record the asset value. It was land. We said that carrying amount of 13 plus the gain of 7,000, and get back to 20,000. So that is, so in short, 7,000 must be added to that of the asset value. That's the debit. So this is the debit section. This is the credit. Then you are done. How to appear. So that is the end of the revaluation gain or loss. That is the end of the revaluation gain or loss. So basically, that's the treatment. Now there's another trial that you have to look out for me. And then we are done. There's a reverse of it. A reverse of it. Good. So basically, we are done. Good. Then we look at the asset depreciation, the treatment of the asset depreciation. We calculated it last week. Now the treatment is that for asset depreciation, it must be a policy for you to move it from your revaluation reserve to the retained earnings. So it can be moved from the revaluation reserve to where the retained earnings. We are done. Okay. Now we are done with revaluation. So we are done with the subsequent measurement. But I left with three items for us to look at after. Then we are done with the IAS 16. So let me list them on the board and quickly scan through them. Then we are done with IAS 16. Then pick IAS 40 and finish it. IAS 40 is 20 minutes work. So yes, still have time. Now let's see. The three items that left for us, not all that plenty. First, we have what we call complex assets. Complex assets. We'll have look at it under the inception, but we'll look at it again here. Complex assets. We said that some of the assets they are joined together by major components, and then for that matter, we can depreciate the components separately, or each of the components have a different life, so we can depreciate the components separately. So for instance, complex assets, example include what? Aircraft. Good. So let's assume that the entire body of the aircraft will be the body. Let's assume that the value is Ghana city, is a million, city of 15, but let's make it 80 million. And then the useful life, assume that this body can last for 25 years. So last for 25 years. Then you go to the internal fittings, like the fixtures and fittings in the internal deco. Good. Or we can also talk about the undercarriage. So undercarriage is also a part. Undercarriage. Good. So the undercarriage. Oh. So assuming that the undercarriage RE2 is around let's say 20 million. And then the engines, maybe the 3 engines, 1, 2, 3. Each of them is 30. Each of them is 10. So in the 3 making 30. Let's assume that the whole year there will be there will be there will be 180 flights. 180 flights. And then the engines too will be here to be 2,000 flying hours. So 2,000 hours. Good. So that's the life. So have you seen that these are the components of the asset? In fact, in reality, there are more. Yes, there are more. So the standard permits us to depreciate them separately. So we thought, okay, in the first year of operation, in the first year of operations, in the first of operation, the company went for 30 flights. So in year one, they had about 30 flights, and they fly for each flight went for let's say 100 hours. So each flight, in fact, let me see what the case. 30 flights and what? And 300 flying hours. Yeah, done. Calculate the depreciation for the first year. How are you going to do that? So first, so we depreciate them separately. So let me calculate it here. Depreciation. You can do it here. Depreciation, something like this. First, the body. How do you get the depreciation for the body? You pick the value that's 80 million. So here's a million. 80 million divided by 25. Answer. So 80 million divided by 25 will give us 3.5. So 3.2. So that's 3.2 million. That is the body alone. Depreciation per year, 3.2 million. Then you go to the under carriage. That one too is going for 180 flights, but just that in the first year they had what 30. So therefore that one too, you get the depreciation per what the flight, and then you multiply by what 30 flights in the first year. So to give out 20 divided by 180, right? That gives us 0.111 times the 30. So let's say 3.33. So 3.33. That is the depreciation. I hope you can show the working. So it's tell the examiner that it is 180 20 divided by 180 times the 30 flight that they've made for that year. Then you move on to that of the engine. So the engines do 30 million and gain 200,000 hours, and they fly for 300 hours. So therefore it will be 30 divided by 2,000 times what? Times 300, and then you are done. That'll give us 4.5, right? Good. So therefore, what's the total depreciation of these assets? So therefore, the total depreciation will be, that will be 7, okay, there. So 11.03 million, and that is the depreciation aggregate separately. So we are done. Now let me explain overall. In addition, overall. Yes. Here, some of the assets they require a routine. Good. So here, all what, let me take it again. All what we are saying is that in a situation where the asset is complex and they have different components, and all the components to have a different useful life, then you can what depreciate them separately. Good. Here, just that the asset life has been stated in a number of lives. Good. So that is it. So you depreciate it separately, then you sum it together to get a total depreciation. So this one will be total what? Depreciation. Then you are done. So you pick the body, you are 25, get the answer. You pick the undercarriage, so depreciation will be 20 million over 180. Just like here, for the first year, year one, the aircraft had what? 30 flights. So therefore, the depreciation for that year will be 30 times what? The 20 divided by the 80. And the same will be applied for that of the engines because they had 300 hours. Then get this answer and sum them up. That's the total depreciation. If you want to get the total value of this aircraft, it will be what? 130 million. Agreed. Because 80 plus 20, that will give us 100 plus 30, making 130 with with a depreciation of what 11.03 in the first year. So therefore, the current amount will be the 130 million less what the 11.03 million, and then you are done. Good. Now, because I was saying some of the assets require major overhaul at a regular interval. Now, in fact, some of the assets, the complex one, they required a major overhaul. They required major overhaul, a routine, a regular basis. So assume that I have an aircraft. Every 3 years, go for major overhaul. Every 3 years, go for major overhaul. So here the standard is saying that the cost of the major overhaul, you can treat it as what? As a component and depreciate it on its own. So the cost of what? The major overhaul, treat it on its own as a component. So here, all what I have to do is add what? Major overhaul. Let us know this asset, every 3 years, they have to go and do a major overhaul with that of the aircraft. And then it will cost them, I know it will cost them what? 6 million. So major overhaul after every 3 years. So I'm just updating the question. So let me add it to the question. So all the other information here remains constant. All what I'm adding is every 3 years. So in the third year, the company have to, or the aircraft have to go what? Major overhaul. So call it so overhaul of 6 million. So therefore, when I calculate the depreciation, there must be a section for what? Overhaul. Every 3 years. So the life of the overhaul becomes what? 3 years. So therefore, you write here overhaul. You open your brackets, you take the 6 million over 3, you get what? 2. So the depreciation for that of the overhaul will be what? 2. So that is it. You put all of them together, you get what? 13.03, and you are done. So in short, overall, to complex assets can be what? Treated on its own separately and depreciated. Great. Now let's go to the last aspect of IAS 16, then we are done. Then we resume the IAS 40 quickly. Yes, major overhaul every 3 years. So every 3 years, go in for major overhaul. So you see, every 3 years we're going for major overhaul. We assume that that cost of or that cost that you're going to incur, it will be treated as a cost on its own. It will be treated as a cost on its own. And then that is it. And then you depreciate it on the life or the next year. How long will it take you before you do another overhaul? Then you are done. Good. Now let's see. Now let's go to the last section of the standard. That's the D recognition. Now we went through the recognition, the measurement. Now we're going to look at what D recognition. At what stage do you stop recognizing the PPE? At what stage do you take the asset from the list of your assets? And then we are done. So therefore, you go in like this. So D recognition of what? Of PPE. So D recognition of PPE. Now, ideally, PPE, when the economic benefits embedded in them stop flowing, then you have to also stop what? Recording that assets as PPE. So, at one instance, the major one is when you dispose the assets. So, disposal. So, first, where the point at which the economic benefits stop flowing to the entity, that's the point now you have to stop recording that assets. Good. And then the common one is when you dispose of the assets, the benefit will cease flowing to you. Now, when you mention disposal, let's see, it has several meanings. Disposal, in some instance, instant it's a waste, disposes of, disposal cap, in that order. Now, you can dispose the assets in three different ways. So, disposal by sale, by sale. Disposal by distraction, destroy the asset. So, disposal by distraction. Good. So, they can also dispose the asset by donation, right? Your old vehicle, you can donate to what? Any homes or anyone at all. You have to stop showing the assets in your books. But for examination purposes, this will be the disposal. So in exams or most of the texts that we read, disposal, they are referring it to the sales. Yes, referring to the sales. Even though you can dispose of asset by destroying it, some of the assets, it might not, no recycling can be made from it. In fact, it's even dangerous. Good. So that is it. Now let's see, we'll go through disposal by sale. What is the accounting treatment? And how do you remove the asset, like derecognition? Good. Or when the asset useful life comes to a successful end. Yeah, derecognition will take place to go off. Then let's see. So the accounting treatment, and then that's the end of the game. We'll pick one few illustration. First, so steps, accounting treatment. You know what? Disposal. Very important. So step one, step two, step three, you are done. So step one, add the proceeds to your cash balance or your cash at bank. So the cash balance, so add the proceeds. Add the proceeds to where? To your cash or bank balance. Cash or bank. What if you dispose it of through pro bono or donation or by distraction? So that one there's no cash you're going to add. You don't receive anything. So you don't add to anything. Two, calculate the profit or loss on disposal. Profit or what? Loss on disposal. Good. Here I'll give a format. If you want to determine the profit or loss, and if you want to determine the profit or loss, you are saying relax, calm down. Compare two items. How we did for the revaluation gain or loss, the same thing we're going to do here. So first, to get the profit or loss, so P&L on disposal, compare two items, the same proceed that you have recorded in your cash book. Bring the same figure first. So first, the proceeds, how much you obtain from the sale of the asset, so much, less the carrying amount at the date of sale. What's the carrying amount of the asset? So much. Then, if it is positive, we have what? A profit or a gain. Negative is a loss. This is the P&L. If it's a profit, it must be recorded where? Profit must be recorded in the other income. If it is a loss, it must go to where? Loss will go to operating expenses, then we are done. So that is it. Loss goes to where? Operating expenses. Then the third one, I normally call it do the thing. What do you mean by the thing? That's to do the removal. That means the details of the asset must be removed from the books, must be cancelled, must be released, must be derecognition. That's like you have to pass other entry. So must be removed. So removal of the details of the assets. Of the details. In fact, here the details, I mean only two items. One, cost from cost. One, cost of the asset, and what? The accumulated depreciation. Good. So these are the two items that we have to take off. Good. So that is it. So how do you do the entry? How do you do the entry? So that is the game. This first, so on January 2009, an item of plant was disposed of for 1.25 million. So item of plant was disposed of for 1.25 million cash. Yes. That means the proceed must be added to the cash. If it's by check, add to bank balance. The proceeds have been treated as sales revenue by Boafo Yena Limited. The name of the company is Boafo Yena Limited. The plant is still included in the above trial balance figures at cost 4 million and accumulated depreciation 2 million. That's nice question. Good. So that means they have accounted for the proceeds. The proceeds has been recorded correctly, but they've done it wrong. The cost of the disposed asset is 4 million and then accumulated depreciation is 2 million. Please, this accumulated depreciation, not always the examiner will give it to you. They'll give you a detail that you can use it to calculate what the accumulated depreciation yourself. Good. Now let me go to the board. Have you seen these three steps? Most often, we can do this one for you. But take note that when we do this, we do it wrongly. Through entry, we will do one side correct, add to the cash, and then instead of us to record it in a trial balance, we will not do that. And we find something to subtract it from or add to the sales. Either we take it off from the cost of sales or we add to the sales. So when you sell plant, you don't add it to what? The sales revenue, because it's not sale. What do? It must be accounted for on its own. So that means you have to go to the sales revenue and take it off, right? Good. And that one, the first stage. Then second, we calculate the profit and loss. Third, do the removal. So let's see how best we can solve this. So first, let's calculate the profit and loss. It was disposed for 1.25 million. So first, the proceeds will be what? 1.25 million. So that's the first thing that we are going to do. So first, proceeds 1.25 million. Wow. 1.25 million. That means. So first, the profit and loss on disposal. On disposal. So first, proceeds. How much they sold the asset for? Don't forget your currency, 1.25 million. What is the current amount at the date of disposal? They say the cost is 4 million less accumulated depreciation of 2 million. So therefore, the current amount is what? 2 million. So they had a profit, right? So here there's a loss. Loss on disposal of what? 0.75 million. So that means in our profit and loss, we add 0.75 million to our operating expenses. We are done. This is step 2. And then step 3, you have to do the thing, that's the removal. Take the details of the disposed asset from the list. So we go to their trial balance and we take off a cost of 4 million from the entire cost and take 2 million from the accumulated depreciation. Then we are done. Then we are done. Good. Good. Now let's see. Let's go to the financial position and pick the cost of the entire asset. The cost of the entire asset, that was plant. So plant at cost 38,300. So that's 38.3 million. So we take 4,000 from the 38. So get 34,300. So therefore, the cost of the remaining asset will be, that's the workings number 3. Let's do it here. I write plant here. And say costs. Balance brought down is 38.3 million. I write disposal here. They sold what? 4 million. So left with what? 34.3 million. I'll go to accumulated depreciation. Now to balance brought down. Let's go and pick the balance brought down for accumulated depreciation. Down to they had 20. They had 12,300. So that's 12.3 million. Here to it will be 12.3 million. Then you say disposal. What's the accumulated depreciation of the disposal? Say 2 million. I'll take the 2 million off 11 what? 10.3. We are done. That is the end of the game. So this is the accumulated depreciation of the remaining. It's on to cost of what? The remaining. Because you can't sell a particular asset and that asset will still be on your financial position. No, you can't do that. An examiner will not do that for you. For step 2 and 3, no examiner will do it for you. But for step 1, We do it sometimes wrongly, and they will inform you that, oh, we've done it wrong. So come in the right thing for us. 2 million. It's 12.3 million. Okay, so that is the end of the game. Please, I'll be sending more questions on this so that you try them for me. Then we are done. Now, the last aspect is if there's a revaluation on there's a revaluation on the disposal or any of the asset that they've disposed of, there was a revaluation gain coming from that asset. Yeah, the standard permit two treatments. Either all the revaluation gain will be what? Be transferred to the P&L as a gain, or it will be maintained, the revaluation surplus. These are the two options available. Then we are done. Please, I will come out with a section on IAS 12 and IAS 16 combined. We call it tax on the revaluation, taxation of revaluation. That's the deferred tax on revaluation. How to calculate the deferred tax on revaluation. Good. So watch out for that one. What level disclosure? If I disclose everything, the carrying amount, the value, depreciation, the rate, the method, and then that is it. So please join us for the question solving stage so that we solve questions together. So that is it. If you do have any question, kindly ask before we close I will end the chapter of the IAS 16 and resume the IAS 40 quickly. Good. Great. Now let's change the game to IAS 40. You are welcome. IAS 40. In fact, the illustration that I've done here, I'm not well satisfied with it. So an assumption that you will try more for the amount. Kindly work on 2014 November. The name of the question is Ajinkwan Limited. 2014 November. Let me see if I can project a part of that question. Note 2. It's Ajinkwan Limited. Note 2. Ajinkwan Limited. Note 2. That's question number 1. Yes, question 1. Great. Now we can proceed to the IAS 40. To finish the IAS 40. Good. IAS 40. But IAS 40 and IAS 16 are very good friends. They are very good friends. They are in good terms. They are twins. They move together. Good. So IAS 40, you are welcome. Why is that from 16? You are jumping to 14. Why? Because you are in good terms. So let me start with those who are in good terms first and come to those who are not in good terms. Then look after them. But normally, the same day I finish IAS 16, the same day, that I should finish with IAS 40. Good. IAS 40 talks about investment property. Investment property. Investment property. That is the IAS 40. Basically, you should know 5 items. 1, 2, 3, 4, 5. If you pick every standard 5 items, 1, objective and scope. 2, definitions stated in that standard. So definitions. 3, recognition. 4, measurement. 5, disclosure. The most important ones are definition, recognition, measurement. That's all. That's the most important one. The rest, you can read them for the notes. Objective of IAS 40 to prescribe what? correct account treatment of what? Investment property. Yeah, then. Scope. It covers all investment property except those covered in other standards. Yeah, then. Definition. So let's go and define investment property. Come to recognition, come to measurement, and then we are done. Now, the definition of investment property is very long. So as a result of that, I'll break them or group them into components. Good. So starting like this, if you combine all of them together, then we form the definition. So investment property is a property made up of what? First, property, right? Made up of land or building. So land or building or part of a building or parts of a building or both. That's the first feature. So a motor vehicle cannot be classified as what? Investment property. Why? It's not land. It's not building. Good. It's not land. It's not what? Building. Good. Yeah. We're not saying intend to building and what? Land. How we get it? Good. Let's say removable tent. I'll come to that one. Good. Two, acquired by an entity or held by an entity. Acquired by an entity or held by an entity. So, acquired by an entity with an intention. So, with an intention not for use. Not for use in what? In production of goods and services. So in production of goods and services. Goods and services. Or for administrative purposes. Or for administrative purposes. You can also check that one in. Come out for admin purposes. Not for use in production of administrative purposes. Or sale, not for sale in an ordinary course of business. Good. So here, this point is just saying two items. You are not going to use it, you are not going to sell. So in summary, all what the second point is saying that the asset that you've acquired, you are not going to use it. You are not going to sell it in the normal course of business. That's the point two. Then point three. So the question is, why will you buy assets and tell that you are not going to use that asset, especially land and building? You buy a nice building or land, you are not going to use it, you are not going to sell it. Then what for? But for rental income, but for rental income, or capital appreciation, or both, yes, or both. So that is you are looking for rental income at the same time capital appreciation. So that is the investment property. Have you seen it? Please, you can summarize these points. Not plenty like this. So here, All they're saying is a property made up of land or building, part or both, acquired with an intention not for use in production or admin services, or still in what an ordinary course of business, but for what rental income or capital appreciation. Rental income means you're going to put it to better renting avenue. So you rent it out and generate income from it. Capital appreciation, you wait when the value of the land appreciates and sell it at a higher amount. So assume that you have maybe a single plot at East Legon and the value there is not encouraging. So after 5 years, the value will appreciate and then you will sell it for a higher amount. It qualifies to be investment property. Basically, that is it. Now let's look at some examples of investment property. 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 Example. Examples of investment property. Examples. Example number one. Land held for capital appreciation. Land held for capital appreciation or long-term capital appreciation. You can include long-term there. Land held for long-term capital appreciation. Capital appreciation. Two. Property leased out under operating lease. Property leased out under what? Operating lease. Also qualify. Then the third one will be parents leasing out a property to a subsidiary. So parent leasing, but here there's a danger. I will step in to look at it. Here there's a danger. Here there's a danger. Good. There's a danger. Now the issue is this. Between the parents and then the subsidiary. In a parent book, the parent will record what? Investment what? Property. Subsidiary book, he will record it as what? PPE, owner occupied. And then what about the group account? The group account, no investment property. It must be recorded as what? As PPE. That's the only tricky section. Good. That's the only tricky section. So that now let's look at the issue. So parents leased out a property to who? To the sub. Just that in the parent books, it will be recorded as what? Investment property. Yes, it's qualified. Parent book only. In a subsidiary's book, is receiving the goods or the land or the building. So you call that what? Owner occupied. So that's PP. And then in the group account, that's in the consolidation. There's no investment property because you cannot sell to yourself or rent something to yourself. Good. That one in consolidation is what? Owner occupied. That's PP. Then we are done with the examples. Then we are done with the examples. Good. Now I can add a fourth one to it. Let me see. Or let me ask this. Assuming that we are building our one of our office complex. We are done with the office building. But decision to move in has not been determined yet. In fact, we don't know whether we are going to move in or we are going to even sell it or we are going to even rent it. Can we classify it as investment property? We have acquired building now. We've not made the decision to move into that building yet, or we've not made the decision to use the building or sell the building. So we don't know. The building is there idle. So now can we tell ourselves that we have investment property? Yes. Okay, great. So, so it must be classified as what? Investment property. Good. Now let's look at the recognition. Recognition of investment property is the same as what? IAS 16 recognition. So PP, so that one we move on. So investment property must be recognized in the books as what? Non-current assets. If two conditions are there, what are they? Mhm. Probable that future economic benefits will flow to the entity embodied in the investment property or associated with the investment property will flow to what? The entity. Okay, so the cost of the investment property can be measured what? Reliably. That's the condition number two. That's the condition number two. Good. Now let's go to measurement. Measurement two, there are two types. What are they? Initial measurement and subsequent. Initial measurement is also the same as what? IAS 16. It must be at what? At cost. So initial measurement of investment property it must be what? At cost. Here the cost include the three costs that we saw. Just that here, not all the costs that are valid in PP will also valid here because this one deal with what? Land and building. Don't forget that you can't transport land. You can't transport building. So some of the costs that are in IAS 16 PPE are not valid here. So take note of that, even though they are the same. And then the startup costs must not form part of the cost of the investment property. Aside this, the rest are what? The same. Then we are done with what? Initial measurements. That's why I said when we started the IAS 16, I said we are going to meet it three times. This is what some of them. This is the second time. We're going to meet it again. This is the second time. That means here I've relaxed without writing anything on the board because we've done the first time. We are going to meet it at third time again, and then you'll be fine. Good. Now let's go to the subsequent measurement. Here they are right, but here there's some slight difference, even though there might be some difference. So subsequent measurement of what? Investment property. That's where we are now. Wow. And that's the end of investment property. What level is what? Question solving. Question solving. And please, the question solving, they can be moving you between the subsidiaries own. It's very topical or examinable, highly examinable. Now let's see. Subsequent measurement of investment property. Subsequent measurement of what? Investment property. So IP. Let's call it IP. IP. Now the entity have to choose between two models. What are they? First, cost model. Cost or model. Second, fair value model. Fair value model. Yeah, there is good news. The good news is that the cost model under the IAS 40 is the same as the cost model under IAS 16. So whatever we did there also remains the same here. So we are not going to work through. Just pick a question to illustrate it and then you are done. However, the fair value model is not is not equal to the revaluation model under the IAS 16. That one is not. So what you have to know is the difference between these two. So when the examiner is moving in between models or between this IAS 69 40, you can grasp it for us. Good. Now let's see some few differences between the fair value model. The major one is that here we don't depreciate the investment property under what fair value model. We don't depreciate investment property held under what fair value model. We don't depreciate such investment property. Good. So let's look at some few differences between the investment property and IAS 16. That's the fair value model and what? Revaluation model. Good. Then we'll in right at the level question section. Now we have what we call IAS 40. We will call it fair value. If an examiner asks you the difference, don't tell the examiner that one is called fair value, one is called revaluation model. One is an IAS 16, one is an IAS 40. All these terms will be mentioned in the question so that you don't repeat those stuff for us. And then IAS 16, we call it revaluation model. Now, let me use my guide here. Distinguish feature number one. Distinguish feature number one. Depreciation. One, we depreciate the asset. One, we don't depreciate the asset. No depreciation. Here, no depreciation. IAS 40, we don't depreciate the. If it's under fair value, but the cost model under IAS 40 is the same as IAS 16. So that means some of the investment property can be depreciated if you adopt what the cost model, you can still depreciate it. But if you adopt the fair value, no depreciation. No depreciation. Yes, we depreciate the asset. Depreciation must be from that's the first thing. Second, the carrying amount. Because we don't depreciate the property, the carrying amount of the asset is equal to the fair value. That's it. Because we don't depreciate the asset, the carrying amount is equal to what the fair value. Here, the carrying amount is equal to what? Who can remember? Fair value less what? Subsequent accumulated depreciation and subsequent to what? Accumulated impairment loss. So that's the difference number two. Three, how do you record the changes in the fair value? So here's depreciation, here's the carrying amount, and here's changes in fair value. How do you record it? Revaluation gain. Under the IAS 40, the changes in the fair value of investment property, that one, it must be recorded in a P&L, whether it's a gain or loss. All changes must be recorded in a P&L. Oh, so if it's a gain, add it to other income. If it's a loss, add it to operating expenses. However, under the IAS 16, gains have a different place. Gains are recorded in where? OCI. Where losses are recorded where? The P&L, right? Good. So this is the difference between these two. Here, whether it's a gain or loss, it must enter the P&L. But here, gains have a different place. Revaluation losses also have a different place, and then you are done. So that's the feature number three. Feature number four. IAS 16 can be applied to all assets, all non-current assets. It can be applied to what? All what? Non-current assets. All non-current assets. You can revalue them. But IAS 40 cannot be applied to all non-current assets. Agreed. Example, it can only be applied to what? Land and building. Assets that made up of land and building. So land and building. Assets that relate to land and building. Good. That is it. So this is the difference. Now let's look at the last aspect. We call it transfer. It's very important. But that's where they will pick some of the questions and then they will examine you on. So our next section, I'll pick question on transfer and question on the group, how the investment property affect the parent and the subsidiary. If the parent afford giving some property to the subsidiary. Good. So let's look at the transfer, and then that's the end of today's section. Good. Transfer, transfer, transfer. And that's where your question usually may come from. Or between the IAS, the consolidation. So transfers. What do you mean by transfers? Let's see. There are various types of transfer. Here you are moving the assets from owner occupied to investment property, and vice versa. So transfer number one. You are moving from owner occupied. When you say owner occupied, we are referring to what? The PP. So it's formerly you're using it, the owner was occupying in. And then now you transfer it to be what? Investment property. And reverse is also true. It can also be investment property, and now you transfer to what? Owner occupied. Two. The first one, owner occupied to be investment property. Assuming that your current head office, you've built a new head office. So you have to relocate to what? A new place. So that means the existing head office will be what? Be idle. So once you're in business, you decided to rent it or look for the value to appreciate and sell it at a higher amount. So you can hold it for what? Investment property. So that's from where? Owner occupied to investment property. And then from investment property to owner occupied, sometimes you can have some flat. As we have some flat at East Legon on rental, executive flat. Then you need office for one of your managers or office for a small executive office to run some of your administrative work. So you go there and then inform the tenant that when the time is up, you won't accept any advance again. You are going to occupy in. That's from where? Investment property to what? Owner occupied. Good. Can also move from here. Investment property to what? Inventory. And then the reverse is also true. Can also move from inventory to investment property. Let's assume that you are selling land and building. I don't know whether because the price is high, people are not buying. If in fact the whole year, none of them have even come ask you the land of your price. The 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 land of your price. The price of your land. None of none of the customers have asked for it. So what do? Okay, if you're not asking, then let me put it there. 5 years later, I'll sell it. I'm not going to sell it any longer. Now you move it from where? Inventory. From where? Investment property. You can also move from investment property to inventory. Some land that, one of the purpose of investment property is what? For capital appreciation. So maybe I hold this land for 5 years. So in a fifth year, the value will appreciate, and then up to the fifth year. So in the fifth year, I will classify that land among my inventory, ready for sale, goods ready for sale, and I'll dispose it off. And then the third one is transfer between the models. You can transfer from cost model to fair value model. That means, and vice versa. Formerly, you were using cost model on your investment property, but now you feel like you want to use what? The fair value model. So that one is also allowed, and then the reverse is true. So these are the transfers available. Good. These are the transfers available. And that's the end of the game. So our next section, I'll pick three illustrations. One on this, that. In fact, this one is the issue, the most topical issue. The rest, in fact, they are not other. And I pick question on the group account. And then we attempt. So that is it. But expect question solving video on IAS 40 and IAS 20. Yes. No, before Wednesday. Good. That is. And please, thank you very much for watching. Please, if you have not subscribed, kindly subscribe to the channel, share the link, and then join us when I'm solving the questions. You'll be fine. Great.